The most dangerous sentence in personal finance is not a lie because it sounds dishonest. It is dangerous because it sounds responsible. Put your money in the bank. Leave it there, sleep well. That sentence has destroyed families before. In 1929 and the years that followed, thousands of American banks did not stumble, merge, or quietly restructure. They failed, they shut their doors. Men and women who had worked carefully, saved faithfully, and avoided obvious mistakes walked up to buildings they had trusted for years and found a sign on the glass where their future used to be. Most of those people did not lose because they were reckless. They lost because they misunderstood one word. They thought the word was money. The real word was structure. I have spent most of my life studying businesses, balance sheets, incentives, capital allocation, and the difference between what looks safe and what is safe. That difference is where fortunes are made, and it is also where fortunes disappear. A bank lobby can look safe. A mobile app can feel safe. A familiar logo can feel permanent. None of those things answer the only question that matters when fear enters the room. Who actually stands between you and your cash? That is the question ordinary people ask too late. In calm times, almost nobody asks it at all. The debit card works. The direct deposit lands. The bill pay clears. The balance appears on the screen every morning, as though the number itself were a physical object resting quietly in a vault with your name on it. Daily convenience creates a powerful illusion. It makes access feel like ownership. It makes routine feel like law. It makes a private institution feel like a public guarantee. But a bank deposit is not what most people think it is. The moment you place money into a bank, the emotional story in your head and the legal reality beneath your feet split apart. The emotional story says you stored your money. The legal reality says you extended credit to an institution. Your asset becomes their liability. Your confidence becomes their funding. And during normal times, that distinction stays hidden because the system keeps moving. During abnormal times, that distinction steps out from the shadows and introduces itself with tremendous force. That is why people who appear equally prudent can end up in completely different positions when the weather changes. One person kept cash in a single commercial bank because that was what respectable adults were taught to do. Another person held operating cash in one place, reserve cash in another, emergency transaction cash outside the system, and surplus liquidity and direct government obligations with no private intermediary in the middle. On paper, both looked cautious. In reality, one person owned a routine, the other owned a structure. History rewards the second person. The history most people remember from 1929 is the stock market crash. They remember the photographs, the headlines, the dramatic language, the feeling of an age breaking apart. But the stock market crash was only the first loud sound. The deeper damage came from banking failure, from a public discovering in real time that confidence is not a decoration attached to the financial system. Confidence is the load-bearing beam between 1930 and 1933. Roughly 9,000 American banks failed. That number is so large that many people hear it and move on too quickly. They should not. 9,000 failures means 9,000 local centers of trust going dark. It means payroll money vanishing. It means merchants unable to buy inventory. It means families finding out that prudence without structural understanding can still end in disaster. What is rarely taught with the same force is that not every institution failed equally. That is the part intelligent people should linger over. The survivors of financial stress are not always the boldest. They are often the people who asked better questions before the panic arrived. What kind of institution is this? Who owns it? What incentives govern it? What liabilities sit ahead of me? What happens if speed matters? What happens if access freezes before guarantees are processed? What part of my financial life depends on a single gate staying open? Those questions sound technical until the morning they become personal. There were institutions in that era that held up far better than ordinary commercial banks. There were structures designed with depositors more centrally in mind and with less appetite for chasing returns through fragile channels. There was also an older American solution that has nearly disappeared from popular financial memory, a simple and powerful arrangement that placed the federal government directly between the saver and the promise, rather than placing a private bank in the middle and adding an insurance story around it afterward. That idea mattered. Then it matters now. I am not interested in frightening people for sport. Fear is cheap. Headlines can do that without help from me. I am interested in something much more useful. I am interested in teaching the difference between comfort and resilience. Those are not the same thing. Comfort is how a system feels when nothing unusual is happening. Resilience is how your life holds together when something unusual happens quickly. Most people build for comfort. People who last build for resilience. That difference begins with abandoning one childish idea, the idea that all cash is the same simply because all cash is denominated in dollars. It is not. Cash has jobs. One portion of your cash must move quickly. One portion must sit close enough to reach when life turns ugly. One portion must survive payment interruptions. One portion must stand beyond the failure of any private intermediary. When people dump all of those jobs into one account because the app is easy and the logo is familiar, they are not being disciplined, they are being lazy in a socially approved way. The world flatters that laziness because routine is profitable for institutions. I have never admired routine for its own sake. I admire systems that survive contact with reality. Reality has a bad habit of arriving on an ordinary morning. A small bank fails. Regulators close it. A regional lender with too much exposure to slow, illiquid assets suddenly cannot meet the speed of withdrawals. A rumor travels faster than a balance sheet. A congressional debate that once sounded theoretical becomes practical because officials are arguing about coverage limits, staffing, guarantees, and whether the architecture people depend on is as strong as advertised. None of these signals, by themselves, prove catastrophe. That is not the point. The point is that architecture should be examined before it is tested. You do not buy fire insurance while the house is burning. You do not learn who owns your cash while the branch door is locked. The deeper lesson from every financial panic I have studied is that the winning move is usually boring before it becomes brilliant. It does not feel dramatic to divide cash by function. It does not feel heroic to keep one institution for operations, another for reserve liquidity, a physical transaction bridge at home, and direct Treasury exposure outside the banking chain. It feels almost disappointingly plain. That is exactly why it works. The best protections in finance usually feel underwhelming right up until the moment everyone wishes they had put them in place. The first mechanism you must understand is what I call the convenience trap. Human beings confuse frequency with safety. The account you use every day starts to feel like the place that deserves all of your trust simply because it is nearby, familiar, and frictionless. That is how concentration hides inside convenience. The very smoothness of the experience persuades you not to ask whether a utility tool has slowly become the central pillar of your entire cash life. A checking account is a utility tool. It is not a philosophy. It is not a fortress. It is a pipe. Pipes are valuable. They move water where you need it. But a wise man does not mistake the pipe for the reservoir. He certainly does not store all of his family's future in a pipe and call that prudence. The second mechanism is the structure law. Brand does not save you. Reputation does not save you. Marble floors do not save you. Apps do not save you. Structure matters because structure determines the order of claims, the path of contagion, the quality of supervision, the nature of the guarantee, and the number of steps between you and final repayment. In every crisis, investors discover again that two assets with the same yield on a good day can behave like two different species on a bad day. That truth does not only apply to common stocks and bonds, it applies to cash. The third mechanism is the speed problem. Most people picture financial failure as a slow-motion event. They imagine weeks of warning, newspapers full of clues, a long runway for action. That picture belongs to another era. Modern banking operates at digital speed. Information travels instantly. Withdrawals travel instantly. Fear travels instantly. By the time the public story sounds serious, the institutional reality may already be irreversible. A system that feels stable on Thursday can be in government hands by the weekend. That means a plan built around reacting after the first visible crack is not a plan. It is a hope. I do not allocate capital on hope. The fourth mechanism is the intermediary problem. An insured bank account is not the same as a direct obligation of the United States Treasury. Those statements may sound close enough to a casual ear. They are not close. One arrangement places a private institution between you and your claim, then surrounds that arrangement with rules, limits, procedures, and public confidence. The other arrangement makes the sovereign itself your counterparty. In one case, you are relying on the stability of an institution and the effectiveness of a response framework. In the other case, there is no private intermediary left to fail in the middle. That distinction is the hidden hinge of this entire conversation. Once you see it clearly, many bad habits stop looking prudent. This is where I would like to change your identity, because identity is what sustains behavior after the first emotional reaction fades. Most people think the responsible saver is the person who keeps a large balance in one respectable bank, avoids obvious speculation, and calls that caution. That picture is incomplete. It is the picture of a compliant participant, not the picture of a serious steward. A serious steward treats cash the way a good engineer treats load, bearing parts. He does not ask what feels simplest. He asks what fails together and what remains standing when one piece breaks. That is the identity shift. Do not think of yourself as a depositor. Think of yourself as the designer of a custody system. That is how wealthy families behave, even when they never say it in those words. They do not merely save. They arrange, they separate functions, they remove single points of failure, they assume that convenience and resilience must be balanced rather than confused. Once you adopt that identity, the blueprint becomes obvious. Your first layer is operating cash, and it belongs in an insured institution built for everyday motion. Payroll arrives there, bills leave there, cards connect to it, automatic drafts run through it. This layer is not designed to be heroic. It is designed to be useful, keep enough for the machinery of ordinary life, and not much more. A month or two of true operating expenses is reasonable for many households. Some businesses need more because payroll and working capital have their own rhythm. But the principle does not change. The more money sitting in the operating layer beyond its functional purpose, the more you are paying a hidden premium for habit and calling it safety. People often hear that sentence and imagine, I am hostile to banks. I am not hostile to banks. I am hostile to misuse. A hammer is a good tool. It becomes a bad home. A bank account is a good utility channel. It becomes a bad long-term repository. When you ask it to perform jobs it was never structurally meant to perform on your behalf. The first layer should be boring, highly visible, and limited. It is where cash moves, not where your entire margin of safety lives. Your second layer is reserve cash. And here structure begins to matter in a way most people ignore. A reserve layer belongs in a different institutional channel from your operating layer. For many Americans, that means a well-run credit union rather than another commercial bank wearing a different logo. People underestimate what a different legal and institutional framework can do for resilience. Member-owned institutions do not carry the same incentive architecture as shareholder-driven ones. They also sit under a separate federal insurance framework. Independence between protections is not a trick. It is the whole point. Redundancy only counts when the redundancy is real. Holding two accounts at two commercial banks that behave similarly, rely on similar funding expectations, and sit under the same general logic may feel diversified while remaining psychologically concentrated. Holding operating cash in one framework and reserve cash in another is different. Now, a single institutional problem, a single technology failure, a single fraud freeze, or a single regulatory action is less likely to touch both pathways in the same way at the same time. That is what resilience looks like in practice, not panic separation. The reserve layer should not be so large that it turns into idle complacency, and it should not be so small that every inconvenience sends you scrambling. It exists to buy time. Time is often the rarest asset during any disruption. Time to think, time to transfer, time to avoid forced decisions. Time to let official systems process what they are going to process while your life continues functioning. A wise reserve is not dead money. It is breathing room. The third layer is the one people talk about most emotionally and usually handle worst. Physical cash outside the banking system. The emotional argument for it is easy. The practical argument is more important. Physical cash is not there to make you feel like a character in a movie. It is there to bridge a temporary interruption in digital access. That means it must be sized for function, not fantasy. 1 to 4 weeks of normal household expenses is often enough to matter. More than that begins to turn a transaction tool into an inflation sink and a storage risk. Less than that may leave you exposed to exactly the short gap this layer exists to bridge. And denomination matters. That lesson has been taught repeatedly in hard times and forgotten repeatedly in easy ones. In periods of disruption, the ability to transact depends not only on having money but on having usable money. Small bills carry real utility. A stack of large bills can prove strangely awkward at the exact moment you need flexibility most. This layer should be plain, mixed, accessible to you, inaccessible to casual trouble, and completely unromantic in its design. You are not building a shrine, you are building a bridge. The fourth layer is where the whole architecture stops being conventional personal finance and becomes something sturdier. Surplus liquidity that you do not need for immediate operations, near-term reserve, or short interruption coverage should not automatically sit inside the banking chain, merely because that is what people are used to. The modern saver has access to a tool that is conceptually similar to an older American solution that worked precisely because it removed the private intermediary. You can purchase short-term Treasury securities directly from the federal government. No commercial bank owns the relationship in the middle. No brokerage is required to stand between you and the obligation. The sovereign becomes the counterparty. That matters far more than most people realize. In a bank account, your confidence is partly confidence in an institution and partly confidence in a system of backstops. In a direct Treasury holding, your confidence is in the government's obligation itself. Those two forms of confidence may travel together in ordinary conversation, but they are not the same claim. A direct short-term Treasury bill is not a promise wrapped around a bank deposit. It is the obligation. That is why it does not need deposit insurance. There is no private depository in the middle waiting to become the weak link. Many people hear this and say the move sounds too conservative, too serious, too prepared for a future that may never arrive. That is precisely how sound preparation always sounds before it is needed. The same people who call a 4-layer cash system excessive will often leave 6 figures parked in a single low yield account because moving it would require an hour of thought and a small admission that their old assumptions were lazy. Human beings rarely resist good systems because the systems are flawed. They resist them because good systems expose old intellectual negligence. I would rather be embarrassed by belated clarity than flattered by a fragile habit. A short-term Treasury layer also accomplishes something else that people frequently miss. It forces categorization. Once you move surplus cash into direct government bills with specific maturities, you stop pretending that all dollars deserve identical treatment. Some dollars are workers, some are guards, some are shock absorbers, some are strategic reserves. Mature investors do not merely accumulate cash, they assign it a mission. That mission-based mindset changes behavior across your whole financial life. It changes how much idle money you leave exposed to convenience. It changes how you think about insurance limits. It changes how you think about yield. Because now the question is no longer, where can I park this, and forget it. The question becomes, what is this money for? What can threaten that purpose? And which structure best protects the purpose while it waits? That is a much better question. Now let me make this still more complete, because the strongest financial systems are not only layered, they are governed by rules. Without rules, good ideas dissolve back into habit. The first rule is that operating cash should be defined by actual monthly reality, not by vague comfort. Look at the last year of your life, calculate the cash that truly moves. Mortgage or rent, utilities, insurance, food, transportation, necessary subscriptions, payroll if you run a business, taxes that must be paid, known obligations that recur. Do not round upward to flatter anxiety. Do not round downward to flatter bravado. Learn the number. Precision creates calm, vagueness creates hoarding. The second rule is that reserve cash should exist to cover timing, not permanent fear. A reserve is not there because the world is ending. It is there because the world occasionally becomes inconvenient at high speed. Job loss, payment delay, transfer freeze, regional outage, illness, regulatory processing, fraud investigation, cyber disruption, the reserve layer buys decision, making time. So you do not liquidate long-term assets or accept desperate terms because a short-term interruption cornered you. The third rule is that physical cash should be maintained like a tool, reviewed like a tool, and refreshed like a tool. It does not sit there as an ideological statement. It sits there because payment systems fail, machines go dark, storms hit, networks get attacked, and institutions close for reasons that have nothing to do with your personal merit. The fourth rule is that strategic cash should default toward the strongest direct claim available rather than most familiar private channel available. This is where many intelligent people go wrong. They optimize for brand familiarity when they should optimize for claim quality. A direct claim beats a wrapped claim when your purpose is capital storage rather than institutional convenience. The fifth rule is that no single institution should ever be allowed to become psychologically irreplaceable. The moment your life depends emotionally on one bank, one password, one routing system, one branch, one customer service line, one piece of plastic, or one app notification, you have already surrendered more resilience than you realize. That is the rule most people break without noticing. They outsource calm to a logo. I have no interest in doing that. The strongest investors I have known were not always the most brilliant in raw intelligence. Quite often they were the least delusional about systems. They understood that every structure has failure modes. A railroad has them, an insurer has them, a utility has them, a bank has them, a government has them. Wisdom does not require pretending a system is perfect. It requires arranging your affairs so that one system's weakness does not become your household's catastrophe. That is where the middle of this story becomes more important than the beginning. At the beginning, the message feels like warning. In the middle, it becomes liberation, because once you see clearly that resilience is built through arrangement rather than fear, you stop feeling like a victim of large institutions and start acting like an owner of a private protocol. You no longer ask permission from the financial culture around you to be more deliberate than average. You no longer wait for newspapers or politicians to tell you whether caution is fashionable. You do not need a panic to justify good architecture. You only need the humility to accept that systems break and the discipline to separate your life from their weakest points. That is the identity flip I care about most. The average person says, "I hope my bank remains fine." The serious steward says, "My household remains functional even if one pathway stops." Those are not the same sentence. One is dependence, the other is design. And design carries a moral advantage that people miss. It reduces the probability that stress turns you into a forced seller, a desperate borrower, or a frightened decision. A well-layered cash system is not merely about preserving dollars. It is about preserving judgment. Financial pressure narrows intelligence. It makes small problems feel total. It pushes people into ugly compromises. The person with time, liquidity, and optionality is not just wealthier on paper. He is freer in thought. That freedom is worth more than most yields. Now we come to the part almost everyone neglects, the part where a sensible architecture becomes a durable one. You need a protocol, not merely a set of accounts. Here is the protocol I would build for an ordinary household with no desire to become a full-time student of monetary history. First, define the monthly burn rate of the household with honesty. Know the number. Second, decide what belongs in the operating layer, enough to run life cleanly, not enough to become a lazy warehouse. Third, fund the reserve layer in a separate institutional framework until it truly buys time rather than offering a token gesture of comfort. Fourth, set aside a transaction bridge in physical cash, stored with practicality and discretion, in denominations that solve ordinary real-world problems. Fifth, move remaining strategic liquidity into short-term direct Treasury exposure with maturities that fit your lifestyle and psychological comfort. Some people like very short ladders because they value frequent access. Others prefer somewhat longer intervals for slightly different yield and management rhythm. The exact maturity matters less than the structural principle. Surplus liquidity should not default to a private bank merely because that is what your parents were taught. In a simpler narrative 6, review the whole system on a calendar, not during a scare. Quarterly is enough for many people. Semi-annual can work for simple households, but the review must happen before stress arrives, because the entire virtue of structure lies in not having to improvise under emotional heat. Seventh, teach the protocol to the other adult in the house. A system that lives only in your head is not a household system. It is a private hobby with catastrophic succession risk. Resilience must survive confusion, illness, travel, and absence. That final point carries more weight than it first appears to carry. Many households have assets, but no architecture that can survive the temporary loss of the one person who understands where everything is. That is not prudence. That is a hidden fragility wearing the costume of competence. The mark of a serious system is not that one smart person can explain it beautifully. The mark of a serious system is that the household can continue functioning even when life becomes disorderly. I have seen enough of life to know that disorder always gets a turn. Now let me say something unfashionable. A lot of personal finance education is aimed at making people feel calm rather than making them structurally strong. It is full of slogans because slogans are easy to remember and easy to market. Keep it simple. Leave it in the bank. Stay diversified. Trust the system. Those phrases contain fragments of truth, which is why they survive. But fragments of truth become dangerous when they substitute for design. Simplicity is excellent when it sits on top of understanding. Simplicity is disastrous when it is merely ignorance made tidy. There is nothing complicated about this 4-layer architecture once you stop resisting the fact that cash has different jobs. It only sounds elaborate because the culture has normalized reckless concentration so thoroughly that any deliberate separation starts to look unusual, but unusual is not the same as extreme. Wearing a seatbelt is unusual, right up until a collision. Buying insurance is unusual, right up until a fire. Holding strategic liquidity outside the private banking chain is unusual, right up until a confidence crisis reminds everyone what counterparty risk means. Then it suddenly becomes common sense. I prefer common sense before the crowd arrives. Let me also correct one mistake at the other end of the spectrum. A layered cash system is not an argument for burying all your money in the ground, abandoning financial institutions, or treating every headline as a countdown clock. That is emotional overreaction. An emotional overreaction is just another way to lose discipline. The point is not to reject the system in total. The point is to stop entrusting every function of your liquidity to one part of it. Use banks for what banks are good at. Use direct sovereign obligations for what sovereign obligations are uniquely good at. Use physical cash for what physical cash is uniquely good at. Use structural separation where structural separation buys real resilience. That is intelligent cooperation with reality, not rebellion against it. In my own life, I have always preferred arrangements that let me sleep, because the logic is sound, not because the story is soothing. There is a large difference between those two forms of sleep. One comes from understanding, the other comes from not looking too closely. The second kind often feels better right up until the moment it becomes impossible. The first kind is slower to build and sturdier to keep. That is the sleep I recommend by now. The shape of the larger truth should be visible. The great financial divide is not between people who take risk and people who avoid risk. That is far too crude. The real divide is between people who understand the structure beneath a promise and people who accept the promise at face value. One group asks what happens if the intermediary fails. What happens if speed matters? What happens if confidence cracks? What happens if access is delayed? What happens if official rescue comes more slowly than household life requires? The other group hears a familiar reassurance and stops thinking. Stopping thought is expensive. History sends the bill later, when the old bank failures swept through America. The people standing outside closed branches were not fools. Many were decent, responsible, disciplined people. That is precisely why the lesson deserves so much seriousness. Personal virtue does not override institutional structure. Hard work does not change the order of claims. Frugality does not eliminate counterparty risk. A man can do 10 things right and still discover that the 11th question, the structural one, was the one that controlled the outcome. That is why I am speaking to you this way, not as a lecturer handing out fear, not as a salesman peddling apocalypse, but as a capital allocator telling you that custody is part of investment, liquidity design is part of wisdom, and the place where you store cash is not a footnote to your financial life. It is one of the hidden foundations under all the other decisions you hope to make well. A household that stores cash badly will eventually be forced to make some other decision badly. That is how weak foundations announce themselves. They do not always collapse first. Sometimes they simply make everything built on top of them worse. I would rather you build from the ground up with the assumption that calm conditions are pleasant but not permanent. That assumption does not make a person cynical. It makes a person adult. Adults build systems. Children trust appearances. Financial culture spends a lot of time inviting adults back into childhood because childhood is easier to monetize. Hand over the money. Watch the number. Believe the story. Repeat the ritual. I have no respect for rituals that cannot survive inspection. Inspection reveals the answer very clearly. Operating cash belongs in a limited utility layer. Reserve cash belongs in a separate framework that buys time. Emergency transaction capacity belongs in physical form outside the digital chain. Strategic liquidity belongs, to the greatest extent practical, in the strongest direct claim available. That is not paranoia. That is architecture. And architecture is what turns a pile of dollars into a durable financial life. One day, perhaps years from now, perhaps sooner than anyone expects, some disruption will arrive that feels sudden to the public and obvious in hindsight. A bank will fail. A region will wobble. A payment system will go dark. Officials will say the right words and television will distribute reassurance with admirable speed. Most people will wait to hear whether they should worry. They will look outward for permission to think. That will be their mistake. By the time the public asks whether structure matters, structure is already deciding outcomes. The right moment is now. While the doors are open, the screens are lit. The transfers work, and rearranging your cash life feels almost annoyingly easy. The right moment is before urgency supplies the motivation. The right moment is before you can point to stress and say, now I finally see it. Seeing it late has never paid well. I will leave you with the test that matters. Do not ask whether your current setup feels normal. Do not ask whether everyone around you does roughly the same thing. Do not ask whether your institution has a comforting brand or a polished app or a long history or a handsome branch. Ask a harder question. If one pathway failed tonight, would your household still function tomorrow without panic, without begging for time, and without selling something valuable under pressure? That is the test. That is the standard. That is the line between having money and having a system. In the end, wealth is not only what you earn, it is what you can still reach when the world becomes inconvenient, political, frightened, fast, and unfair. The people who endured the hardest financial eras were not always the people with the highest incomes. Very often they were the people who understood that when confidence breaks, structure speaks, make sure yours says the right thing before it has to,